Hey, what's going on, everybody? It is Monday, January 24th. Woo! What a roller coaster ride today. Market down big in the morning and ended up closed up today. I'm going to talk about that. It's Monday. I sent out the new issue of MMT Trader. So check it out. If you want a copy of that, go to my website, pitbulleconomics.com, or send me an email if you're interested in an individual subscription, because the rates now on the website are for institutions. If you're interested, let's see if we can make it happen. Send me an email at mnorman@pitbulleconomics.com. All right. So, as I was saying in my last video over the weekend and on Friday, we have a situation here where basically the federal government is running a balanced budget. And I've been talking about this now. When this gets out into the media, and it eventually will, the stuff I bring to you, I bring to you ahead of everybody else, because I follow these fiscal flows every single day from the daily Treasury statement. And let me just say, I do have a video course, Understanding the Daily Treasury Statement. It's $99. It's probably the best $99 investment you'll ever make, because that is an amazing free resource put out every day by the federal government. It's literally the checkbook of the U.S. Treasury. It shows every withdrawal and every deposit. And you were talking about billions or tens of billions or sometimes hundreds of billions in a single day. And that moves the markets. It drives the economy. If you know how to read that report, and that's what my video explains, you could do the same kind of thing that I do in tracking those flows. Anyway, federal government is basically running a balanced budget, maybe even a slight surplus right now. It happened very, very quickly. What I was about to say is, when that's going to get out into the media, they're going to be cheering that, and the White House is going to be cheering that. Hey, look, we're running a balanced budget. We'll have a surplus. That is not good. The only way that the government can run a surplus is by taxing more than it spends. So that is a net withdrawal from us, the non-government, the economy. I mean, that's taking our money. It's not adding anything to our financial balances. It is reducing our financial balances. I've been using the swimming pool analogy. No water left in the pool anymore. The suction, the pump has been pumping out faster than the water is coming in, so the water has been completely drained out. That is not a good thing. But when you hear it in the media, and when it is announced by Jen Psaki, the White House spokesperson, they're definitely going to pump that up and say, oh, this is a fantastic thing. The economy cannot run very long in that scenario. It can run because of bank credit, or due to bank credit. And we see a natural expansion in bank credit when you stop getting those checks, right? People tend to tap their credit lines. And I see this very, very clearly in the data, in the banking data that comes out every Friday. I mean, credit card loans are way up. They're growing at the fastest pace in 4 years right now. And that's because the stimulus has faded. And because of the political climate right now in the Senate, we're not going to get another stimulus. So, as I said in my last video, there's a limited upside now, because the economy is going to slow down, and it's going to slow down significantly. And I would say that the risk of recession is growing. Excuse me. Dryness in here. So, getting back to the market, it's not going to crash, even though the last couple of days it feels like a crash. We still have a fair amount of fiscal support flowing into the economy, about 430, 450 billion, maybe a little bit per month, maybe a little bit more than that. That's not bad. That's like pre-pandemic levels. All right. The difference is no more deficit. So again, a reduction in the non-government's financial balances. okay? But you can buy the market as a trade when we get into these very oversold, really emotional types of sell-offs, such as the one we just had over the past couple of days. And I can tell you that on Friday, the put-call ratio, and I think I mentioned this in my last video, on Friday the put-call ratio hit 1.26. That was the highest reading since March 18th, 2020. And March 18th, 2020, we were in the pandemic crash, if you could remember that. If you go back and think about that, that was the pandemic, that was the shutdowns, the first phase of everything closing down, wildly spreading pandemic, people dying like crazy. We had that crash. March 18th was one day before the turnaround, and we hit 1.26 on the put-call ratio. The only thing is, the days prior to that, there were a bunch of days over 1. We haven't had that really, a bunch of days over 1, but 1.26 is a pretty high reading. I think back then we got up even to 1.8, and I think that was the highest reading ever. 1.8 on that put-call ratio. Anyway, 1.26 is very elevated. I sent out an email today to my subscribers saying, hey, look, you can buy these real panicky dips for a bounce. Today we saw it. We came off really deeply oversold levels, and we ended up. And I suspect that the market will have some upside momentum, for a little while. But my strategy right now is to sell into these rallies. With the government, with the federal government running a balanced budget or maybe even a small surplus, I think we're looking at stagnation in the economy. I mean, we're just not going to see these massive net transfers to the non-government like we have over the last 2 years. I mean, when you think about it, it was really an extraordinary period. All of these stimulus programs that were put through. We're not going to have that now. So the economy is going to have to find a new equilibrium level. It's going to be at a much slower growth rate and could even be recessionary, because what are companies going to do when they find that their sales are slowing down? I mean, they're going to try to cut costs, and the first thing they're going to do is lay people off, and people are going to lose their jobs. We do have automatic stabilizers. Those are unemployment benefits, Social Security, Medicare, Medicaid, disability, military pay, veterans benefits, stuff like that. But those are going to kick in a much bigger way if the economy starts to contract, because then you're talking about people losing their jobs, applying for unemployment. I'm already starting to see a small pickup in daily unemployment benefits flows. All right, they bottomed out December 28th at 122 million per day. They're now up to something like 158 million per day. So about a 26%, something like that, 26% increase in those daily unemployment benefits flows. And that to me is a little bit of an indication that we might be hearing about higher layoffs. All right, so that's where we're at. Stagnation, government running a balanced budget, maybe even a slight surplus. You got to sell the rallies now, but you can buy dips when it gets very oversold like it just did. All right, and I think in the short term we could see a continuation of this bounce that we got today, but don't expect to see new highs in this market for quite some time. I think that's probably a good, kind of characterization of the market environment we're going to be in for a while now. Anyway, don't forget, go to my website, pitbulleconomics.com, pick up that course, Understanding the Daily Treasury Statement, and I'll see everybody tomorrow. Bye.